I'd like to make 3 points about the recent monetary policy decision of the state bank. First is that Pakistan has done better than anticipated in containing COVID. If you look at new cases per million of population, it's about 65 cases per million in the world. In Pakistan, that number is 1.3. Second, if you think cases are overreported, if you look at positivity rates, they are about 0.9 in Pakistan compared to north of 7 in countries like Russia and the US. So since Pakistan has done better than anticipated in containing COVID, the significant stimulus that we had given during COVID was no longer needed. That was the first consideration. The second, Mandy, is that growth in Pakistan is stronger than anticipated. Even with the tightening that we have done on Friday, the central bank expects the Pakistani economy to grow 5% this fiscal year that ends in June of next year. This is a 4-year high, and this growth is reflected in robust and brisk demand of even non-energy imports in Pakistan. So that was the second factor, that growth is stronger than anticipated. And finally, as a result of stronger than expected growth, the current account deficit has widened moderately more than we had anticipated. In the last Monetary Policy Committee meeting, we had thought that the current account for the fiscal year would end up in the range of 2 to 3% of GDP. Now we expect it to be moderately more than that. That weakening of the current account deficit and a couple of other factors has put undue pressure on the exchange rate, and the Monetary Policy Committee, being concerned about the lagged effect of exchange rate developments on inflation, thought that from a combination of these three factors, it was time to begin to moderate monetary stimulus a bit faster than we had earlier anticipated.
Indeed, you're absolutely right to point out that there are a number of sources that are potentially worsening the inflation outlook, and certainly the higher than expected primary budget deficit is one of them. What other tools can you maybe use to try and keep a lid on further inflation? I know that for the first time in a decade you lifted the cash reserve requirements at commercial banks, for example, but what other levers do you see yourselves maybe pulling?
Pakistan has a coordinated approach towards bringing down inflation, and we must realize that when inflation runs high, it particularly erodes the spending power of lower income households, and therefore it is imperative to take any and all actions to bring it down. One part of inflation is due to food supply related issues, and there the government has a very proactive and coordinated stance to try to relieve supply bottlenecks so that produce gets from the farms to the markets in a timely manner, and also to ensure that there is no hoarding or speculation in the prices of basic commodities. Second, one factor of inflation is international commodity prices. Unfortunately, there is not much that emerging markets can do on that front, because not passing through international oil prices, for instance, just leads to a buildup of imbalances, whether on the fiscal side or on the external side. Where we can do something, and we have demonstrated, number one, is to moderate domestic demand so that inflation expectations and demand side factors do not add to the supply side factors that already exist. The cash reserve requirement is another tool we used, and that was primarily meant to mop up liquidity, because money growth has recently been growing slightly ahead of its trend. As you know, in COVID, central banks around the world have realized that they have to use not only interest rates as an instrument, but also they have to use quantitative measures to manage monetary policy.